Hi, I'm Pattu from freefincal. Today, let's talk about a typical question that investors in active large cap funds have, and we just have SBI Bluechip as an example. My fund has been underperforming for the last few years. Should I stop my SIP and invest elsewhere? Now, it's very easy to say that immediately say that look, stop investing in actively managed large cap funds, switch over to nifty fund, sensex fund, and so on. That's fine, that's the right advice, but we have to look at that advice in a proper context, in the proper perspective. I don't want to blindly support passive investing without appreciating both sides of the situation. Now, we have been talking about the existence of a market imbalance at least since February 2018, but I recently showed that actively managed funds had trouble beating the Nifty for the last 7 years now. So there is that. Now, this market imbalance essentially means that if you compare Nifty 50 and Nifty 50 equal weight returns, that is, in the Nifty 50, like we saw, for example, Reliance Industries occupies about almost 15%. Next comes HDFC Banks, Infosys, and so on, almost about 10% each, about 9-ish% each, and so on. And then the others drop down. But if you look at the Nifty 50 equal weight, then every stock will have about 2-ish% exposure. There is a huge difference between the Nifty 50 returns and the Nifty 50 equal weight returns. Basically, the top few stocks of the Nifty have been driving the Nifty and the Sensex up for the last few years, and the other stocks have not moved up as much. So this is the kind of this is what I'm referring to as market imbalance. During the March 2020 crash, this imbalance reduced for a short time, almost disappeared for a short time, and then it has come back again. So for those of you who have been looking at value research returns table, a few years ago, if you were to sort funds, for example, in terms of 1 year returns or 2 year, 3 year, whatever returns, you would see the actively managed large cap funds would have the 5-star ratings, and they would occupy in the top portion of the table, and then only you will have Sensex and Nifty funds. But recently, for the last couple of years, the situation has completely changed. In fact, last year, if you were to look at it, you would see only Nifty and Sensex in the top. Nifty and Sensex index funds are ETFs on the top, and then would come the active funds. Now the situation is more or less like it's a balanced kind of situation. Some actively managed funds are on top, some then come the Nifty and the Sensex funds. Now, if you were to look at the if you go to value research and sort large cap funds by star rating, and if you look at the 5-star funds, if you look at the portfolio of the 5-star funds, for example, Axis Bluechip has got 8% of Reliance, HDFC Bank 9.6%, Infosys 9.8%, Canada Robeco Bluechip, Reliance 8.8%, HDFC 8.3%, Infosys 8.14%, Invesco India 14% Reliance, HDFC 9.58, Infi 8.67, Mire 11.68 Reliance, HDFC 9.48, Infosys 8.47, Sundaram Select Focus, Reliance 8.89, HDFC 8.16, Infosys 8.38. In contrast, if you were to look at the fund we are talking in this post, SBI Bluechip only holds 4.95% of Reliance, 9.5% of HDFC Bank, and about 4.5% of Infosys. Today, the situation is that if a actively managed large cap fund holds more of Reliance, more of HDFC Bank and Infosys, it has got a 5-star rating. This is what can I say? I don't know. It's a very as an analyst, if you look at it, it makes you wonder if Nifty and the Sensex are the right kind of benchmarks to even look at this, because what the room for active management has considerably come down because of two reasons. One is SEBI restricting what an actively managed large cap fund can do. It must invest 80% of its portfolio in the top 100 stocks. Then at the same time, this market imbalance became very stark. That is, the market became driven by just a few stocks. So it's a case of too many things happening at the same time, and it's very difficult for you to understand, to actually point out this or that as the reason. So it's I mean, I don't know. It's hard to say, to find fault also with actively managed large caps. As a neutral person, I'm not trying to. I don't want to be one of those guys who blindly support passive investing at all costs. I think that's not a right stand to take. I am all for passive investment. I have been recommending passive investing. In fact, for the last couple of years, more than that, I have been talking about how passive investments are better in many ways. But that doesn't mean, as an analyst, if you look at it, there is so much of imbalance in the market, and you can't simply say that, look, if a fund doesn't hold a single stock, that means it's a poor performer. Yeah, that means that I mean, is it right to even use Nifty and Sensex as a benchmark? Is a question that we should ask. I'm not making that accusation. I'm only saying, at least let us ask that question. Whether we find answers or not is a different matter. I mean, I don't know why we should not have weight capping on Nifty and Sensex. You can't have, in a 30 stock index like Sensex, 17% is going to one stock. I mean, that's just a little too much. And why can't we cap the weights to 10%? I mean, why not? Because after all, when these index curators create low volatility indexes or momentum indices or alpha indices, they are capping the weight at 5% or 10%. Where is the logic in that? If they can do it there, why can't they do it here? I mean, I don't know. I mean, these are questions that we should ask as an analyst. But as an investor, you would say, look, I just want the returns. I don't care paying 2% fund management fee. Yeah, I don't care if Reliance is have 15% exposure. If the fund is having 15% exposure to Reliance, I just want outperformance. And yeah, that is correct. But the problem is that not all the funds would be able to outperform this index if this kind of a imbalance is going to persist. And some funds might, but it may not be your fund. So as an active fund investor, what happens is that you would basically be chasing that the best fund which is able to outperform, and you would look at past performance, enter. After 2 months, the performance will come down and you will feel bad. So this is the main reason why you should switch to index investing or passive investing. I'm not saying don't do it. I'm saying do it, but do it for the right reasons. What I'm trying to say is that if you choose index or passive investment, your portfolio will be tidy. You don't have to worry about peer performance. You don't have to worry about that fund outperforming, this fund outperforming. You'll just get the market returns. There's nothing wrong in that. When you are going to chase market outperformance, then there will always be a chance that the fund you invest would at some point in time in the future underperform. So if you are choosing passive funds for the right reason, that's well and good. It's okay to do it when your portfolio is young, when your portfolio is just a few thousand rupees, you've just started. Otherwise, when your portfolio becomes a dinosaur like mine, you'll have a lot of inertia in changing. For a portfolio of my size, I don't want to switch to passive investing. It's just too much inertia. I don't like it. I'm not comfortable with it. I'm happy where I am. If I have to undergo some periods of underperformance, and I'm okay with that. I would be happy to build my portfolio around aggressive hybrid funds instead of large cap funds. But that's my stand. I'm not going around asking people, am I doing the right thing? Am I doing the right thing? If you are happy where you are, go ahead and be happy where you are. But this is the situation. And I have gone through periods of underperformance in active funds. So these are the two sides of the issue. You will have to take a call on what is acceptable for you, because I don't want to be that guy who blindly supports passive investing. I support passive investing because of its inherent simplicity, and where the portfolio is lean, mean, and just minimal, and you don't have to worry about it. You can focus on, for example, if you're a young earner, you can focus on other things, and not be dependent on outperformance and then worry about whether it's outperforming or not. So those are the options in your hand. And those are two sides of the story which you have to consider.